Was it cheaper to buy a home in the peak of the market in February or just last month in August? Well, it might seem obvious, but I think the answer is going to shock you. In the past 6 months, we've seen decreasing prices month over month in most of the major GTA markets. And to break down the affordability, our team this week was looking at the monthly cost of purchasing a home in February compared to August, and the answers were pretty interesting, so we thought we would share them with you. Before we get into this, if you like this kind of content, feel free to subscribe to our YouTube channel, and if you're looking to buy, sell, or just talk real estate in general, you can click the link below and book a call directly with our team. There's been a lot of people out there that have been waiting for prices to continue to fall in order to save money in the market. And the question is, are they actually going to be saving money? It seems like they would, as prices have been falling month over month, like we mentioned, but there is another factor at play here that's been talked about a lot in the headlines lately, and that is the rising interest rates. I think as consumers, we have a tendency to look at the purchase price of something and assume that if it's cheaper, it's going to save us money. But looking at these numbers here, you're going to see that it's also very important, not just only to know what the purchase price is, but also what kind of interest rate are you getting for your monthly mortgage payments. Now we're going to take a look at two examples here from February compared to August. The first is buying with the minimum down payment, and the second is buying with 20% down. So taking a look at the first example here, let's assume in February you were buying a house or townhouse, depending on your market, with a purchase price of $950,000. The minimum down payment would be $70,000. And because you have less than 20% down, you would have mortgage insurance, which comes out to about $35,000. The total mortgage then is around $915,000. Interest rates in February were right around 3%, and so that works out to a monthly mortgage payment of $4,350. Now, we know there's been decreasing prices over the last 6 months, so let's take that same house with lower prices but higher interest rates. So let's say in August, that same house would be purchased for about $800,000. Your minimum down payment would be $55,000. Your mortgage insurance works out to about $30,000, leaving the mortgage at about $775,000. Interest rates in August were right around 4.6%, and that works out to $4,327 for monthly mortgage payments. So in February, that same house with the mortgage rates were $4,350. So we're talking about a $23 difference in monthly mortgage payments. Now let's look at the second example of purchasing with 20% down. So if you had $1 million house and you were putting 20% down, your down payment would be $200,000. You wouldn't have mortgage insurance because you're putting 20% down. So the mortgage works out to $800,000, and at that February interest rate of just over 3%, your monthly mortgage payments work out to $3,802. Now that same house, let's say, is worth $800,000 today. Your down payment would be $160,000, which is 20% down. Again, no mortgage insurance. Your mortgage is substantially lower at $640,000, but your interest rate is higher at the August rate of 4.59, and that makes your monthly payment $3,754. And I think it's really interesting to see this on paper because that's about a $50 difference when you're looking at $1 million home when purchasing it in February compared to August. Now there's a couple of key takeaways here, and I think the first is affordability hasn't been affected as much as some people may think. There's a lot of buyers that think they missed the boat because of all the rapid rising interest rates, but prices have also come down quite a bit in the last 6 months. So looking at our example here, you should be able to purchase a very similar property or similar property type now than you could have in February. And on the flip side, we're seeing buyers that are waiting on the sideline for prices to continue to fall in order to jump in on the bottom of the market. And I think that's a bit of a dangerous game for a couple reasons. The first is it is impossible to time the market, and that's because we don't know when the bottom of the market is until it's already past us. Now, there are a couple final things to consider here. If you purchase for $1 million compared to $800,000, obviously there's going to be more closing costs, like things like the down payment or land transfer tax will be larger for the more expensive home. Also, if you did make that purchase in February, you might have to hold that home a little bit longer than if you purchase in August to see the appreciation come back. But if you made that purchase with the long-term mindset, thinking 5-7 years out, which you should in real estate, then I think you'll be okay. So that's it for this video. I hope you enjoyed this breakdown. If you have any comments or questions, let us know below, and have a great day. We'll talk to you soon. See ya.